From the 2013 Spring Roundup, Bob Young, Up, Down, and Sideways.
Little different conversation we did this afternoon than we had this morning. Actually, a lot different conversation this afternoon than we had this morning. Very different kind of subject matter and things of that nature. Wanted to talk with you this afternoon about kind of three general topics, if you will. We'll talk about corn, we'll talk about wheat, we'll talk about cattle. And I'm not going to talk to you today about, I'd be thinking about making sure I had a quarter of it marketed by such and such a date and a third by then and these price objectives and all that other kind of stuff. I think rather than do that, let's kind of talk more about the, here's the kind of general risk factors that I guess I would see for these three commodities and things to keep in mind as you develop your own kind of risk management practices, et cetera, as we go forward. I think as we go through the conversation, we'll come up with some, maybe some general rules or some general thoughts that I'd have about how I'd market crops in the future. But again, we're not going to get into kind of specific charts and things of that nature as head and shoulders and all that kind of good stuff or bands or whatever. I would start out the conversation and say that, it's a very different corn crop today than it was 25 years ago, 30 years ago. Not just the genetics, not just the, understand that today we're talking about, if you just go back a few years ago when we were talking about set-asides, we were talking about 70 million acres of corn, and it might be, 72, it might be 71, it might be 73, but it's going to be about, we kind of had a area just didn't move all that much. And if it needed to move all that much, you just tweak the set-aside a little bit this way, you tweak the set-aside that way, and you had a lot of different controls and variables and levers, et cetera, on the market. You also had, think times past, if we were talking about exports, if we were talking about feed demand, feed demand was going to chew through 4.5 billion bushels of corn. Exports were going to run a couple billion bushels of corn. HFCS, high fructose corn sweetener, cornstarch, things of that nature, that was going to run about 1.2 billion bushels of corn. I mean, you kind of knew this stuff. And so you kind of had a pretty good idea of how big the crop was going to be because you knew, again, on the acreage side because of set-asides, et cetera. And there just wasn't, we'd go years and years and years, and great volatility was to go from, 2.25 to 275. In my ute, I was a ute once. I used to talk about with great enthusiasm, price forecasts of 225 versus 235, that was, we thought we knew so much. Today, I'm going to talk to you about prices as we did, down in Laramie. It's going to be 3 or 4, it's going to be 7 or 8, or in front of it. And I don't have a clue what happens in between, but, that it's just a very, very different market today. Today we're talking about ethanol demand of 4.5, 5 billion bushels, feed demand that's still running 4.5 billion bushels, et cetera. Just a much, much larger volumes. And in order to support those much, much larger volumes, we've got to talk about much, much larger crops. But that also means that the room for error, and then with that, the price volatility that comes along with that is very, very substantial. And that's why I say I think it's a very different kind of corn market, both from the production side, from the marketing side, et cetera, than it was quite a while back. And again, here's just the numbers. Here we were back in the 70s, all the way up really through about 2002, 2003 or so. We fed all this stuff. And so your real question was, well, are animal numbers going up or are animal numbers going down? And that was really where the volatility came from. The other big source of volatility was on the export side of the house. But the real driver of that demand change was what was going on in the feed market. And that was a pretty good shock absorber, if you will, because again, those numbers just don't move all that much from from one year to the next. So you knew, Well, now here we're sitting out here with, a larger portion of demand going into ethanol use. This is feed, seed, and industrial, but the great bulk of that, probably 4.5 billion bushels of this is ethanol. There's probably, again, about 1.2, 1.3 billion bushels of HFCS use and cornstarch and other stuff like that, food use Frito-Lay, you know, all kind of good stuff that would fall in this category. But I'd also say that we've now moved to the stage where this market, we'll talk about this a little bit more, has matured substantially. And these days are gone. And so now but now we're talking about, again, you know, 13, 14 billion bushels worth of demand. That takes a lot of acres to drive that much demand. The other thing we got going for us, let's break that ethanol part out just a little bit. It's a very busy graph. I know you've seen this or something like this the other day, but let's spend some time talking about this because there's a lot of information on this graph. This green bar that comes across the side here are what the ethanol mandates are under the bill that we passed back in 2008. And it basically says this is how much ethanol is to be blended into the gasoline system, into our gas as we move forward. This blue bar is basically 10% of our gasoline. Now notice, you know, 1990 or 2009, 2010, 2011 even, that this green bar stays very nicely below the blue line. And so, you know, you can produce the requirement. There's more than enough gasoline market out there for us to pick that up, to absorb that at a 10% blend, and we all move forward and everybody's happy. Unless you happen to have a boat. That's another story. But notice what happens 2012, 2013. That green line ends up being above that blue line. In other words, we're going to have a requirement to blend this much ethanol, but at a 10% blend, you know, that's all you need. So where does this extra ethanol going to go? Thus the great call for going for the E15. Or you're going to have to come back and sell what they call RINs, certificates that you got for when we were actually using ethanol above. See, you'll notice some weeks back in here, certainly some weeks in here, where we were, and certainly back in 2010, where we were using more ethanol than what the mandate required. And so in those periods of time, we issued RINs, we issued certificates to folks that said, you used more than you have to. Sometime later, when we're not using as much as we're supposed to, you can cash those RINs back in. And we've got enough of those RINs. We got about 2 billion bushels, 2.7 billion gallons or so of those RINs outstanding that theoretically are going to take us through this coming year. Now talk to me about the year after that. So there you are. This red line is what we actually produced on a weekly basis. The green line is what got blended into gasoline. The gap in between that either ended up, for the most part, ended up as exports or ended up going into stocks. Most of it ended up as exports. So again, a lot of information on that graph. Yes, sir.
So the mandate for 12 to 13
is up there.
How long is that in effect, and how often does Congress address it to move it up or down? Or is that set in stone for perpetuity now?
It's in perpetuity, and it's supposed to go up to 15 billion gallons up there. It's going to continue to ramp up.
By law?
By law, it continues to ramp up. So you have to come back and change law. Let me show you one more slide. You're going to have to come back and change law in order to change that provision. Unless EPA comes in and says we're just going to waive it and move on from there. And they have waived the requirements, for example, for the advanced biofuels.
But they just got done saying they're not going to waive this.
That's exactly right. That's exactly right. And here's the problem, or however you want to phrase that. When we passed this law, again back 2007 or so, this was the expectation of what gasoline consumption was going to do in the United States from here on. So here we are sitting in 2012. The expectation was that we were going to be consuming almost 150 billion gallons of gasoline. 148, 149, something like that. Well, we ain't. Recession, and other reasons that I don't know why necessarily, that all those high mileage vehicles are finally hitting the road, finally, making up a larger proportion of the fleet. We're just not driving as much. I don't know why. I don't think anybody really knows why. Here's what we actually did. Here's what the forecast was in last January or so, is that we'd be back on this upward trend. Finally, EIA, which is the Department of Energy agency that does all the forecasting, their economic forecasting, finally their forecast now says, okay, well maybe we're wrong and we're on this kind of much lower path. Well, here we're talking about 133 billion gallons as opposed to 149 billion gallons. So there's 7.6, almost 15 billion gallon difference. 10% of that would be another 1.5 billion gallons of ethanol. And so again, to go back to this graph, if I threw you another 1.5 billion gallons of ethanol onto 13.5, that's 15 billion gallons. World would be great. But it ain't. So what are you going to do? And again, I will not be at all surprised if we don't end up with conversation as this year unfolds to talk about going back and re-looking at the RFS. I don't have, I know what we'll do as Farm Bureau about that, but there's going to be, and there's also a full court press that the Petroleum Institute's got on now to basically say, get rid of this.
Maybe if they don't, will the petroleum people then say we're going to stop producing, which is then going to take fuel prices and jack them up, in addition to that?
No, I don't think they'll say they'll stop producing. There's too much money involved. But this is what, it's not a question of producing. This is what consumers are buying. The oil companies can do whatever it is they want to do. If the consumers don't buy, the consumers aren't buying.
How does that correlate with the gas price changes?
And that would be another reason that you could say that you're down here as opposed to where you were up there. Again, remember back in 2007, 2008. Don't forget that while gasoline prices back in that time spiked and we got up to that $140 a barrel, that was in July. By the end of that year, price of oil was down to less than $40 a barrel. We took $100 a barrel off the price of oil in a period of about 6 months. So, and gasoline prices came right back down to them. We were up in the 4.25 range or so, on the East Coast anyway. By the end of the year, we were back down to under 2, or right at 2. So,
Question for you.
yes, sir.
What is Farm Bureau stance? Do they want to see lots of ethanol?
Yes.
For higher farming?
Yes. Well, we want higher ethanol use. I will say at our annual meeting in Nashville just this last, just a couple weeks ago, there was an attempt made to soften some of our language. One of them got through, another one didn't get through, so, we're...
From the livestock interest in Farm Bureau?
Yeah. And we have a lot of internal conversation on this issue, maybe is the way that I should put that. We have a lot of open and frank exchanges of views on this topic. But I would make the case, and again we talked about this down in Laramie, that while yes, I don't know that ethanol is necessarily what's driving our volatility, our price volatility at this stage of the game. One of the things, again, don't forget that we're doing substantially different today than we used to do. You go back in the 1980s, and this red bar represents government-controlled stocks. All those government stockpiles, whether it was 9-month loan or CCC directly owned or farmer-owned reserve. I think I told this story down in Laramie. This would have been in 1988, summer of 87. I'm doing a tour. The staff used to be allowed to do junkets. And the Wheat Export Commission put a group together. We actually started at Glacier. No, we started in North Dakota and then worked our way all the way over to Portland and, Port of Portland and all that kind of good stuff. So as we're making this trip, and at the time, you may not know this, but USDA every week put out a catalog, yay thick, of here's where government stocks, either farmer-owned reserve or CCC-owned stocks. Here's where they are, what year they went into the reserve, you know, yada, yada. Just a full, complete detail of all this stuff. Well, you know, before going on this trip, I'm kind of flipping through the catalog or whatever. And there was like, and in theory, you know, remember the way the rules worked on FOR? That stuff went in, and in theory it was in there for 3 years and then it had to come out. But, you know, folks always managed to find ways to keep it in there longer if they decided they wanted to. So here it is, 1987, and there was some Durham wheat that had gone into the FOR in 1976, the first year we created the FOR. And it's still there, or at that time.
Physical wheat itself? Or is it paper? Okay.
It's there. So we end up someplace out in, I want to say Minot or someplace in western North Dakota, I forget where, out and we're doing a farm meeting, you know, like kind of like this. And this lady holds up her hand and she says, "They are telling me that I have to take my wheat out of the FOR. Well, I just don't understand why I have to do that." So I asked her, I said, "Well, when did you put it in?" 1976. I had found it. I had found that wheat.
It actually existed.
And you know, she was getting, at that point in time, you know, they were paying 25 cents a bushel storage per year. And she'd had it, you know, and she had, you know, I don't remember how much it was, 100,000 bushels or whatever in there. And she was basically living between her Social Security check and her FOA storage payment check. That's what she was basically living off of. And you come in and tell her she's got to get rid of that. Wait a second. That's my retirement check. I can't, but anyway. So, understand that in times past, you know, look, for example, in 1988, again, very big drought. You remember that, you probably remember that. Very substantial decline in stocks. And what did we do? Very substantial decline in production. We basically just took it all out of government stocks that year. And if you'll remember, the price of corn in 88, with as big a drop in production, both because we had pick and we took all that land out of production because of pick, as well as having a bad yield. The price of corn in 88 only averaged $2.55 because you just pulled it all out of reserves. And we've done that. It's taken us, you know, notice there's even just a little tiny bit of government stock. These are 9-month stocks, but there's just a little bit of stuff in reserves even up to 2010. But now, I mean, there is absolutely nothing in government-owned or controlled stocks. Nothing. And why would there be? Price of corn, loan rate for corn is less than $2 a bushel. Price of corn, $7.50. Why on God's name would anybody put that stuff under loan? So they're not. So now, when you get a short crop, you know, what's the market saying to you? The market doesn't have any reserves. So the price has to take off. It can't not. How are you going to ration demand? The only way you ration demand, you know, high prices can take care of high prices. So that's where we are. Now I would make the case though on the other side, and let's just talk about this for a minute, that again, government's not going to hold stocks. So if you get into any kind of an oversupply situation, the market says, I'll hold those stocks, but I sure as hell ain't going to hold them for $8 or $7 a bushel. And so you're going to talk about, here's Pro Exporter. I don't know if you know these guys. I find these to be some of the best market analysts that I know. Here's their expectations for next year. And there's a lot of information on this slide we're going to talk about too. 98, this is their expectations for the 13-14 crop. 98 million acres planted. They're expecting a yield of about 156 bushels an acre. Feed used to go back up to 5.2 billion bushels. Ethanol demand to get back up to 4.95, you know, with about 13.8 billion gallons produced. Exports to come back and come back reasonably strong. And we're going to talk about stocks then go on from their expectation of less than 550 million bushels at the end of this year up to 1.6 billion bushels. And a price of $5.65. Now if that's a season average price, you're going to talk about some harvest time prices with a 4 in front of them. And in fact, in central Iowa, you're probably going to talk about low 4s. And that's, as we talked about in Laramie, this is the market that I think we're dealing with today. We're going to talk about corn markets for as far as I can see that are either going to be here or they're going to be here. You're going to talk about stuff with a 4 or a 5 in front of them, maybe some 3s, or you're going to talk about prices at 7 or 8. And you're not going to be anywhere in between. So, how do you market in that kind of an environment? I think, for example, as you're coming out of the short crop situation as we are now, we're going to get out in the spring, we're going to have some problems hitting that 98 million acre number because of weather. Something's going to happen. It's not going to rain, or it's going to rain too much. I don't know what the weather event's going to be, but something will give us a bit of a problem for 10 days. The market will panic, and prices will take off again and jump on those if you're selling. On the other hand, once the crop goes in the ground, everybody says, oh, we got 98 million acres in the ground. Man, we got a lot of corn. Think about how last spring, opened up. There's a reason why prices were doing what they were doing last spring. Crop went in the ground early. At that point in time, we thought it had water under it. It got up. Things were looking pretty good. Yada, yada, yada. And it wasn't until mid-June, when the drought really started taking hold, that prices really took off. Otherwise, they were trading in the 5s. As we talked about at lunch today, they were trading in the 5s. So I think it's going to be that kind of market. It's going to be, high 4s, low 5s, or 7 or 8, and nothing in between. I'd also say, notice here's 98 million acres. They're going to get, their expectations are that we get a few acres back on wheat. Don't forget that this number was kind of artificially low because of some planting issues we had and flooding issues that we had in North Dakota, South Dakota, et cetera. I think those issues, I don't think we're going to have to worry about flooding issues up there this year. So that's where some of that comes from. What else can I tell you on that slide? Soybeans, holds right in at 77 million acres. Price stays at around that $14 mark or so. Wheat price comes down $6.75. We'll talk a little bit more about wheat prices here in just a minute. Come on. Yeah.
The way I'm reading that, they're predicting more corn and more wheat going in. Sorghum's dropping. What crops, sorghum's not dropping that much comparatively. What crops are they figuring
Cotton.
are going to be dropping?
Cotton.
Cotton.
Yeah. Cotton prices are still down in the, 75, 80 cent a pound range or so. And so that, the Texas area, the Mississippi area.
So corn and wheat.
Yeah. And if we were having this conversation down there, they're really worrying about losing infrastructure, that they're closing mills down.
The gins have all shut down.
Yeah,
There are very few
exactly.
gins left.
Gins are shutting
Gins
down.
have shut down. 2 years ago, cotton was made up to $2, which is the highest I've ever heard of it. But $400,000 cotton pickers, you got to have $15,000 and stuff, and everybody got down to the last 10 years going to corn production because we can't make money. So we don't have the infrastructure, we no longer have the capacity that even when the price dictates it, go back to growing.
Also, water use is rather cut on across
In Texas area, yes.
Where I'm growing water.
all that is so
Yeah.
short.
Yeah. In Mississippi area.
Mississippi Delta, water's not an issue.
Yeah.
Getting the water off sometimes is an issue, but it's just we've lost the infrastructure. I've got a lot of farmers when I was a Farm Bureau agent back there that had $300,000 or $400,000 cotton pickers that had been cranked in 2 or 3 years. That gets expensive.
And they're also to the stage now too where the corn infrastructure is getting built. That the bins are getting built and things of that nature, and so it is. I think the days of cotton, king cotton, certainly in the Delta area, pretty well shot. I think you're going to be hard pressed to hold 10 million acres of cotton, 2-3 years from now or so.
Well, that is the domestic economy. Cotton's a big player in a lot of.
It is, but again, the gins, all the mill infrastructure, that turn that cotton into fabric, or yarn that's gone. They're just shipping the cotton overseas anyway, so let me go on here for just a second. Why did I have this up here? I had this up here, but I'm going to show you, put this graph up instead. So, and let's talk about a couple things here. Again, pro-exporter graph. This orange line is the stocks to use ratio. Blue line is the price. And I want you to notice a couple things off of here. First, I want you to notice that historically, the relationship between that price and the stocks to use line, that there was a pretty noticeable gap in there, and that it's not until we've gotten out here into 2000, well, let's say 2007 or so, that gap between prices down here and stocks to use ratios up here, that gap has tightened up substantially. If we put up the standard, and you've all seen these, the stocks to use on one axis and price on the other axis, and how it all fits on this nice curve until you get out to about 2007, and lo and behold, all the points are way up here. Why has that relationship changed so substantially? That was a relationship that we all relied on for 25 years, 25, 30 years. What is it that's made that relationship change? And I don't know the answer to that. Other than, again, just that we've gotten the demand levels have gotten so much higher. And that is basically saying that there's a bigger risk premium in the market, and therefore we've got to charge higher prices. I don't know. But be that as it may, historically, if we were going to talk about a 12% stocks to use ratio, which is remember what we had back over here for last year, or for this coming year, why isn't this working? Again, here's 2013-14, here's their expectations coming out of 2013-14 in terms of stocks to use ratio. Their expectations are for a price to come in at about $5.65. But if you go back and look at years past where we've had 12% stocks to use ratio or better, even as recently as 2009, we were talking about corn prices less than $4 a bushel. And if you go back to the old relationship and look at where we've had 12% stocks to use ratios, there's some more, here's another one, here's some more out here. 250, 275. Now, I'm not going to stand here and tell you we're going to talk about 250, 275 corn prices. Your input costs are such that just ain't going to work. Or it might work for 1 year, but it sure as heck ain't going to work for the second year. But if you were to tell me that, again, if we were to see that kind of a carry out, 1.6 billion bushel carry out, I don't think there's any question that we talk about that. I think that price needs to be closer to $5 and maybe even down to the $4 range or so. So, I talked about if you're selling corn, take advantage of those blips when they come along. If you're buying corn, I'd be hand to mouth. And I'd be just waiting for when that crop does finally get in the ground. Folks will come to recognize that it's in the ground, and then I'd be buying. And I'd be buying, some few months of needs until you know that the crop's made. Once you know the crop's made, we do end up with 156 bushels. Prices get back down there. Then I'd be thinking about pricing significant quantities and maybe years in advance of my feed needs. Because again, that potential for going right back up to $7, it just takes one crop. That's all it takes, is one crop to get right back up there.
Does that spread there have anything to do with storage?
Some. Or you could make that case that was some of it. That again, now that you're so dependent, that you are dependent upon the market for holding all of it, that would be another reason for saying that spread ought to tighten some, certainly. And I do also think that, again, though, it's just that the volume that we're pushing through the system now puts that there is a higher risk premium out there now than there used to be. We could fill up all of our demand needs. The supply could very easily outrun the demand side historically. I don't think we're at that stage now. We're only at that stage now if we can plant 95, 96, 98 million acres or so. And you've got to send a strong signal to bring in dirt, to bring in 98 million acres of dirt. My clicker's not clicking. Wheat. I want to spend a little time on this table as well. But I want to spend it, let's spend a little bit of time looking at that line right there. That here's wheat yields from 2003, we had 44.2 bushels an acre. Trend lines for 2013, 44.5. There's any numbers for there's a 44.5, a 40.2, 43.7. You know, the wheat yield just ain't moving. And so it shouldn't surprise you that wheat area isn't moving either. You know, they're just, in fact, I'm almost surprised that it's held on as well as it has. I'd almost make the case that, you know, we ought to be getting out of growing wheat. I know this isn't the country to be having that conversation, but, you know, I'd also come back and say, you know, again, if when you look at gross revenue, net revenue, whatever, on a per acre basis, if that's what your yield's doing, and all the other competing crops have got yields that are growing, you know, you're kind of in a world of hurt, unless your price is going up substantially. And yes, it's gone up substantially, but most of this, frankly, has been a pull from corn side. It hadn't been price increases that wheat's been able to generate on its own. So that being the case, I mean, yes, we've got wheat growers in very intense conversations with the Monsantos of the world to say, you know, let's talk about, you know, bringing GM technology into wheat production. It's going to happen over the course of the next not too distant future. But it has to happen. You just can't stay that flat in one commodity and expect to hold on to acreage. It's just not going to work.
I think I work with NAS, and so I did wheat when I was in DC, and we actually did a trend line yield for like 20 years out, and the only reason why we actually had an increase on those 20 years of wheat yield was actually depending on what year you start with.
Yeah.
And it's all based on weather factor, and it's not based on improvements in yields or improvements in quality.
And when you think about it, you know, we've basically gone to the, as a nation, we've to a large extent basically said, you know, we're just going to look to the commercial sector to come up with all of our new seed technology. You know, there's just not all that much done at universities anymore. It's just a fact. And so that being the case, you know, the money and the research dollars are going where the money is. And if we're not willing to adopt this technology or take that technology on, we're not going to invest in it, in that crop. There you go. Let's spend a little bit more time too on this export line. You know, we talked at lunch, or the discussion at lunch today was about, or one of the parts of the discussion was about Black Sea region, former Soviet Union countries, Ukraine, Russia, that they come in the market, they go out of the market. You know, when those guys come in the market, they come in the market in a big, but they've got now about a 5-year history of, you know, are they in or are they out, and you never know. So if you're somebody who's looking for a reliable supplier, you know, they're not necessarily who you want to go to. So if you're not the reliable supplier, how do you get market share when the time comes? Flood the market. Price. That's the only lever you got to pull. And so when they come into the market, I think you're going to see increasingly volatile export markets for wheat. Just as you're going to see, you know, the volatility on the feed side, you know, is, you know, 500 million bushels this year as opposed to 240 the year before. You're going to see volatility on the feed side coming from corn yield volatility. You know, you're going to inherit that in the wheat markets, and you're going to inherit the volatility of of weather that happens in Russia and Ukraine. But other than that, you know, it's just not a commodity. It's just not a product that necessarily has, you know, big growth in demand. There's no big demand pull on that for that commodity. So, you know, watch what goes on in other markets, watch what goes on in corn, watch what goes on, and pay as much attention to what's going on in Russia and the Ukraine as to what's going on in Kansas. Because what's going on in Russia and Ukraine is probably going to have more to do with your prices and your price volatility than what's going on in Kansas. So I'd be watching that very carefully. And again, we got to do something on the yield side to just generate revenue for wheat production in order to hold any dirt. Come on. You can do it. Here we go. Let's turn to beef for just a minute. And as was talked about at lunch, I don't know if this is necessarily a very pretty picture at all. You know, we've had, you kind of think through the droughts that we've had, think through the reaction that we had to BSE outbreaks, think through you know, any number of different factors as we've tried to take beef prices up. But we've taken, you know, gone from 65 pounds per capita. 2014, 2013 expectations are we're going to be at about 56. 2014 expectations are we're going to be at about 53. Now, you know, once you lose your place on the consumer plate, I don't know that beef ever gets it back. Because I think there's just too much competition from other meats for that space. You go back into the, you know, say the if this would have gone back into the 80s, we would have been up in the 75 pound per capita range or so and dropped ourselves down to 65. You know, this was a period when those other meats were going through great product innovation. You think about all the different products that the chicken guys put on the, you know, put in the freezer case, put in the, you know, all the ready to eat, all the, you know, all the work that Tyson, for example, did to bring in product innovation to the table, to make it easier for you to eat chicken. I bet if you walked into, I bet if you walked into this school today and picked out, maybe not here, I know this would be the case in Maryland, maybe not even my part of Maryland, but let's say downtown DC, and picked somebody out and said, and plopped a, you know, a whole broiler down on the table and say, cut that up for me, would you? My wife one time back as my kids were growing up was working, and our kids were going to make chicken that night, and so she had to explain to my son over the phone how to cut up a chicken. I wish we could have recorded that phone call, but we didn't. But you know, people just don't eat chicken the way that they did back in the 70s and the 80s, or the 90s even. You know, it's already a boneless breast that's been marinated in lemon sauce, that's, you know, got the chives already in it, yada, yada, yada. You know, we just don't sell that same product anymore. Last time I checked, a filet mignon still looked like a filet mignon. Okay, we got flank steak. You know, I mean, there have been a few kind of minor things around the edges, but for the most part, beef is still beef. It hasn't had the real product innovation that the chicken has, certainly. Think about the pork product that you used to buy back in the 70s and the 80s versus the pork products you buy today. It is a substantially different product than it used to be. Beef is still beef. And so I just think claiming even 5 pounds back is going to be really, really hard. Yeah.
Mostly, I'm predicting or saying that that's because of lifestyle. Ground burger is, you get it at every restaurant you walk in. It's easy consumption, easy management.
And price too.
So, you know, and that was one of the points of the article was steak versus ground burger in today's economy. I've always been under the impression that beef is the rich man's protein, and in our economy today, pork and, well, if you drop all the way down, beans become your most effective protein source. Do you think that as the economy improves, that changes in any way, or do people just lose the taste of the expectation?
I think that's the problem. Once they quit eating it, once they get out of the habit of having beef, you know, 3 or 4 times a week, and get down to where they're having it 2 or 3 times a week, buying that meal back, buying back into that meal space is really, really hard. And again, the other meats aren't going to just, lay there and take it, for lack of a better word. They're going to do whatever they can. You know, we have had the BSE outbreak and the challenges of that, we were riding very high on the export market, and we've got very strong, if we did this in value as opposed to volume, which is what we got here, we're basically talking about, maybe not the records we set in 2011, but we're still talking about very high values and greater value now than we were doing before the BSE outbreak. Export markets have been very good to beef, don't get me wrong. But again, every pound that you ship off here is a pound you don't have to sell here at home. Now, admittedly, it's different products. These are the tongues and the hides and the offals, et cetera, that we don't necessarily want here at home. But again, it's a pound of beef is a pound of beef. And again, as I say, it's a supply problem at this point in time. They're just, beef only comes from one place, and we don't have that many more of them. So here's quarterly beef production. Expectations for 2013 and 2014. Notice that we're going to see these drop-offs. Our expectations are that we're going to see a noticeable drop-off in every quarter in 2013, and in 2014 it just falls even further out of bed. Compare 2014 production, for example, in July, September to what our numbers were for 2012. That's a chunk of beef. That's just not there.
So you're saying our industry-wide advertising isn't working?
No, not saying that. I'm saying this is as much a supply problem as it is a demand problem. And in fact, it's probably more of a supply problem than it is of a demand problem. I do too. I gotta give up on this sucker.
Was the shutdown of the Cargill plant more of a supply? Is that based on supply?
Well, I'm going to talk about that in just a little bit more. So here's what broiler production, for example, is expected to do. It's just going to keep doing what it's doing. And again, that's why I say it's just going to be that much tougher, I think, to get space back, because the other meats aren't stopping. I've served on the CBB and NCBA long-range planning group for the last 3 or 4 years or so. And I was amazed at one of the first meetings that we had, the disconnect. And that committee is made up of everybody from, seed stock folks all the way up to Wendy's. I think it's got folks on the group. And the gist of the producers, of the growers, what is it that you produce? I produce cattle. And you're like, no, you don't produce cattle. You produce beef. And what is it that we need to do to make the beef industry more responsive, more innovative, yada, yada, yada? I produce cattle. The decisions for, how we talk about innovation on the consumer plate, that's somebody else's problem. That's not my problem. My problem is raising the cattle. Somebody else's job is to take care of it. And that's a mindset that we've got to figure out a way to break our way through. I'd also say that to me, this industry has got to think about how big it wants to be. Because you're in a real kind of catch-22 situation at this point in time. The signal, again, beef only comes from one place. So the signal really kind of needs to get back to the growers to expand the size of the herd. As you do the herd expansion, again, that just draws down numbers that much, delivered numbers that much further for a while until the herd begins to work its way back up. But so the price signal needs to be to the grower to expand. But as that price signal to the grower to expand comes, you've also got packers and the Cargill plant that was just talked about. They shut down because they kind of had to. I mean, you don't shut a plant down because you wake up tomorrow and say, I think I'm going to shut down a plant. You shut down a plant because the economics are such that that plant just doesn't make sense anymore. And you think about the slaughter, the feedlot capacity that we have. Our feedlots are the same size as they were back in the 1970s, the number of spaces. We don't have that many animals. So, a guy would say you ought to consolidate or close down some feedlots in order to get a little profitability back in the feedlot part of the business. But most of those feedlots are pretty much debt-free. We paid them off years and years ago. Now the only debt that they have is when we change hands with them. So there's not not really a signal to them to back off. Plus, if you start to close them down, that lowers the competition for your animals, so you don't really want that to happen. But it kind of has to happen in order for that sector of the business to make some money. Same story goes on the packer front, and we're probably going to lose 2 or 3 more plants, I would imagine. You know, probably lose another 8–10% or so, which again is going to cut that much more. You know, so to me, it gets to be a real question of where this industry goes, the spiral that this industry is in, and how it breaks itself out of that spiral. And because again, I think we're going to continue to talk about, as we talked about to begin with, feed costs, corn prices are going to be $4 or they're going to be $8. You know, so figure the average out at someplace in the $6 to $6 range or so. How big does the industry have to be to provide an animal price that will support $6 a bushel corn?
And is the price elastically?
Exactly.
I don't think it is. That's what I'm scared about.
But the thing that
Get squeezed out.
But the thing that I don't understand, and I'm a dumb guy, ask my wife, you know, what is it that is cattle's competitive advantage? You can turn grass into protein. Nothing else can do that. And I've had conversation with folks about, well, let's put them on feed at a heavier weight and get back. No, we're far better off to, you know, put trash feed into them at lighter weights and, you know, do it that way. And, you know, how much trash feed is out there? How many animals can that support? I think you can support a heck of a lot more animals with grass than you can with trash feeds. To me, I don't know. I'm a dummy, as I say. So challenges I think that industry faces. And I'm not giving you good marketing signals or plans here because I don't know that I've got any. So here's kind of where my long-term risk factors. Those markets, ethanol demand is mature. It's as big as it's going to be. Might move up a little bit, but you know, that growth spurt, that's done. And again, because it's so much demand between ethanol, between feed, those two by themselves are as big a market as any market that we would have had back in the, you know, mid-2000s and historically beyond that. So you've got to have a lot of supply, but it doesn't take very much of an error on the supply side to overshoot the demand or to undershoot the demand and talk about, again, those really volatile prices. Wheat, you know, long-term economics, as I said, I just don't think they support wheat plantings, and the Black Sea is just going to make that much more volatility in prices, as well as inheriting all the corn yield volatility as well, that those challenges are going to come into wheat as well. And beef, I'm just not sure how you get out of the spiral. I think you could sell more product overseas if we had more product to sell. But we don't. We are, well, yeah. So that's my conclusion.